Hello, everybody, and welcome to another Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the deferred sales trust, is an amazing way for you to exit highly appreciated real estate businesses, cryptocurrency, defer capital gains taxes so you can create and preserve more wealth, or help your clients, friends, and family do the same. Hi, my name is Brett Swartz. I'm founder of Capital Gains Tax Solutions, and I'll be your host today. Each and every episode, we're bringing on some of the best real estate, financial, wealth, business, and sometimes insurance minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expert CRE secrets as well. So all of our commercial real estate people out there, we appreciate you watching on YouTube or listening to the podcast. Hey, I'm excited about our next guest. He's out of the great state of New York originally. He's now in Florida. And he's on a mission to help his clients create and preserve more wealth using premium financing. But today we're going to be talking about exiting real estate using the deferred sales trust. And we're also mixing some insurance strategies as well. Please welcome to the show with me, Jacob Brigatti. Jacob, how are we doing?
Doing good. Thanks for having me, Brett.
Absolutely. And so for our listeners getting to know you for the first time, could you give us a little bit more about your story and your current focus?
Yeah, so good question. So I'm originally from New York. My family owned a local farm over there, and we actually did some estate planning, premium financing through Vince Muno, our CEO. That's how I got started here. I was actually going back and forth. I was living in Tampa, our office is in Clearwater, just to work through Vince and UFC on the estate planning side there. And I really just loved kind of going back and forth with the team here and ended up getting started. So just been in the industry around 3 years, been mentored right under Vince for all 3 of those years. And I'm really in the business of helping clients. And we have some unique strategies to do so, whether it's estate planning or income for retirement down the road. That's really what we're doing. And we're just trying to help build plans for our clients, right? No plan is fits one size fits all for each client. It's really just building an individual basis of a plan, and we help to do so. So we're excited to kind of show you what we can do and how we can help you.
Absolutely. That's great. And by the way, you can learn more about Jacob Brigatti by going to ufc.bz. No, he's not a fighter in a ring. He's a premium life insurance specialist. And I like the way you put that, custom plans. I think that's so key, right? Because every deal is a little bit different. Actually, I'd like to liken it to a Rubik's Cube, right? And each client shows up with like different things that they're trying to solve for, right? And everyone's cube looks a little bit different with different colors here. And ideally, you're going to get some of them to line up, perfectly and systematically. And there's different life stages, there's different income needs, there's different risk tolerances, and the key is to try to find a team to help to move the Rubik's cube in such a way that it lines up congruently as much as possible, that fits where the client is trying to achieve, right? And so in a sense, we're in the business of solving problems. With that being said, Jacob, let's dive into some of the bigger problems you're seeing some clients face as it pertains to capital gains tax. You're from New York, right? And all over the country, you've seen highly appreciated real estate and a huge capital gains tax. So talk about some of the themes that you're seeing with some of your clients when they show up, without giving any particulars, but just talk about like, hey, someone shows up and this is the challenge they have. And then let's walk through how we can help them using the deferred sales trust.
Yeah, so we come across clients all the time that have highly appreciated assets, like you said, with capital gains on them. And there's not many options of mitigating some of those taxes when you're like deferring them over some of the years. Like we could look at a CRT, you could look at a deferred sales trust, and a few other things like 1031 exchanges. But there's some limitations on some of those too. So you're telling me about the DSTs. Um, Honestly, for myself, I don't know too much about them, just based on what we've talked about. I'd love to learn kind of more about how you structure them. I know you're putting out videos all the time on how you arrange these trusts for clients and how they're benefiting them for them in the future, and you're deferring these taxes down the road, which is really what these clients want. I mean, if you sell something for a few $1 million, why would you want to pay all those taxes up front? You don't want to be a part of that higher tax bracket that first year when you could defer them. So what you're saying is going to resonate kind of with the people we're talking about. And I think it's a good value add to either partner with someone like yourself or even just kind of position someone like yourself for the people we're working with. So I'm excited to kind of hear more.
Yeah, let's geek out a little bit with this. And I can agree with you more, right? I mean, taxes are massive, right? And it's somewhere between 25 and 50% of every sale going to be wiped out by capital gains tax and depreciation recapture, right? And especially real estate. So you've owned it like, for over 27 and a half years for multifamily, you fully depreciated at that point if you've been taking straight line depreciation. If you own commercial property, it's about a 39-year schedule. But if you do these 1031 exchanges, the old depreciation schedule travels, and we call not having a big depreciation schedule, that's not great because that creates more tax. And so we look at something called tax flow versus just cash flow, right? And trying to mirror them up with every dollar you're taking in cash flow, ideally you have tax flow to offset that. And that's the kind of the back to kind of the Rubik's Cube scenario. How do you maximize your wealth by being very tax efficient, but especially as it pertains to large assets that are being sold? So for example, if you bought a property for $1 million, 20 years ago, and it's worth $10 million today, it's a $9 million gain on that gain. Let's just say you're in New York or California, you're looking at approximately 40% of that, probably minimum being taxed, right? So that's a huge tax liability that at the close of escrow is going to be paid. Now, you can do a 1031 exchange like he's talked about, but oftentimes 1031 exchanges for a lot of our clients, they don't want to be forced into a tight time frame, which is not great for making decisions. Two, they don't want to take on a lot of debt right now, with debt not being as favorable as it used to be. Three, they might just be looking to retire and diversify. They're moving more into a preservation mode, which leads into maybe the CRT. And the CRTs absolutely can be used, but they're typically for someone who wants to give it all the way to charity, 100%. And so that becomes, for some clients, that's what they want to do. But most of our clients maybe want to give 10, 20, 30, 40, 50%. They may not want to give all of it to charity. And so that's where we found CRTs aren't as popular as they once were once people learned about the deferred sales trust, which gives total flexibility to either not do a 1031 exchange, but also to not have to do a CRT, but also to be able to diversify within multiple assets. And that's the beauty of the deferred sales trust. It can be back to that customized plan. It can really start to be able to move. And my daughter, if she were here, she could actually, she's the one who put it all to green. I can't actually quite do that yet with, I'm trying to figure that out. She's 11 years old. She can figure this thing out, but, move this thing around in such a way that it starts to align with individual goals. And a lot of those goals are debt freedom, diversification, liquidity, and the ability to invest into multiple assets at any time. And so that's why we love the deferred sales trust. If people want to learn more about that, you go to capitalgainstaxsolutions.com. But Jacob, let's kind of go back and forth a little bit here, right? So what would the ability to have some liquidity and some diversification and perhaps even invest into and go into financing mean for those that are selling huge assets, right? And to be able to convert that into, let's say, a premium financed product to unlock some of the benefits there.
Yeah, so a lot of the clients that we're working with, and I'm going to get to your question in a second, but when they're buying traditional insurance, it really doesn't make sense for the business owners and real estate developers that we're working with. Because when you're talking about the returns they're getting on their own deals, like let's say they bought like a real estate building, their caps that they're earning is like 10% plus. So when you look at a regular life insurance policy and it's earning 5%, that's not sexy to them. So they're saying I could insure myself and just keep my money in my own business rather than earning 5% in an insurance policy. So we actually have a big bank that'll come in and finance these insurance policies for them, where they put up like 10% to 20% of the total premiums going into the policy. And our story looks like this is why don't you keep your money in your own business? It's called retained capital. Retain your capital in your own business, have the bank finance your life insurance policy inside an irrevocable trust, have it, and the returns are looking like 10 to 15% tax free. So 40% taxable, it's like almost 20%. So it's the same types of returns you're looking at there. And the DSTs could be used to complement that because a lot of our real estate developers are getting out of these properties that are highly appreciated. So going back to what you said is when they're building millions of dollars in assets and they've had them for 15 to 20 years, they need to do something. And there's not many options and there's not much flexibility there for the clients. So these could be used to complement each other, right? You need some type of trust to mitigate some of the tax risk there. And at the end of the day, if they're worth 5 or 10 million plus, they need the insurance and they would like to retain all their capital in their business. So we say we're mitigating all those risks. We're saying, not maybe not all of them, but for how we structure premium financing, we do like a 5 year loan rate where we lock it in for 5 years. And then after year 10, we can lock it in at like 5% or 5.5% guaranteed, depending on the company. So these are definitely good complements based on what we're talking about. And we come across clients every single day that could utilize what you're doing there.
Absolutely.
So I
And
hope that answers your question.
it does. Jacob, that was great. And by the way, Jacob Brigada, you can go to ufc.bz, ufc.bz. And so I want to kind of continue on this topic here, right? Of what the deferred sales trust can do for clients with flexibility, but also solving some of the root causes. One of the root causes and challenges with tax is what's called the death tax that the 1031 exchange does not solve for. And that on a stepped up basis, the capital gains tax steps up to the basis of at the time of death. So the heirs get a higher basis, which means they have either little or no capital gains tax at the time of if they were to sell. However, they still have a debt tax, right? And that debt tax is 40% of anything it's still inside of the taxable estate. And so there's basically two options. You can have a stepped up basis or you can have it outside your taxable estate, but you can't have both. Now, a lot of people buy life insurance to offset that debt tax, even though they have a stepped up basis, right? And that's part of the concepts of that. What we like to do is to eliminate that estate tax at the very ground level, right? Tear that root out now. And by doing that, not only do you eliminate the estate tax, but you can also get the life insurance policy. And that life insurance policy is no longer just offsetting the debt tax, it's just a windfall for the family, right? And so it's practicing just great, like Rockefeller type of strategy, right? Where they're looking at and building life insurance policies based upon just wealth creation versus not just offset the tax, right? And so that's the beauty of the DST, that we are going to solve those challenges with the root cause, but also give you the ability to create more wealth. Any thoughts on that, Jacob?
No, I mean, I agree with that. I was actually going to touch on the Rockefeller strategy because we look at two different families that were both billionaires and multi-billionaires back a few hundred years ago, the Rockefellers and the Vanderbilts. And I mean, you know who the youngest Vanderbilt is right now? Or do you know it's actually Anderson Cooper on CNN. And he just inherited one of the family's like last of their money, and I don't know the exact amount, but it was like a few $1 million or $1 million. And they went from having hundreds of billions of dollars to a million. And there was a few factors that factored into that depreciating net worth there. And it's the taxes, just like what you were saying. So if they use some of the tax advantaged solutions, like what you're talking about, that could have helped them out with offsetting the taxes. And it's basically that they're depleting their estate. I mean, the family members were buying all these big hotels and huge, just hotels. They're building beautiful palaces and everything of that sort, rather than the Rockefellers. They were actually buying insurance on each of the kids. So the kids were taken out of the estate, but when they passed away, the insurance would actually go right back into the family trust. So it would replenish all the assets they took out. So I kind of like mentioning that all the time because when you're looking at the two different families, they took severely different paths. And hundreds of years later, I mean, you could see where the net worth is based on their planning they've done.
Yeah, I like to say we be combining the Rockefeller with the Vanderbilt without any of the downside, right? Is one way to think
Right.
about this, right? Because the Vanderbilt wanted to do, let's say in general, just generalizing this, wanted to do more real estate on their own, control the assets, run the thing. But if they had it inside of the taxable estate, well, they'd be taxed at 40% of the value at the time of death, each generation, right? And so I imagine that perhaps they're paying a lot of death tax. Now on the other side, it looks like the generally speaking, the Rockefellers were buying more life insurance type of products that were very tax efficient, and they were replenishing the trust. They were still obviously buying real estate too, but I would love to kind of compare notes on all of those strategies and find out where did the Vanderbilts lose and where did the Rockefellers, win, and vice versa, and then find out what was the biggest expense. I imagine it was probably the death tax, right? I imagine that's probably what it was. And if what we're saying here, we can solve that by using the DST without having to give it away to charity, by the way, without any life insurance required, although life insurance can be on top of that to make extra windfalls, and without having to gift it away, giving up any of the gifting exemptions, which, by the way, as of 2026, as a reminder for everybody, the amounts of exemptions are dropping. They're dropping to about, we think about 6 million single, which is about 12 million married is the approximate amount. Meaning if your estate is worth more than 6 million married at the time of your death, that is the amount that's a difference between that is going to be assessed at a 40% death tax. Let's do an example. Let's say you're a single person and your estate is about $16 million. That first 6 million is exempt, but the other 10 left over will be hit with a 40% death tax that your children have to pay within 6 months of your passing. So either they're fire selling properties, trying to refinance properties, or they had bought life insurance, let's say with Jacob prior to, that had a $6 million death benefit, or in this scenario, $4 million death benefit, right? To be able to capture that upon the death, and that would pay for that. Or they used the DST plus, moved all, let's say 10 million outside of the taxable estate. Okay, so you no longer have that 40% death tax. And let's just say they use some of that cash flow from that trust when they did that, because we typically can increase cash flow by about 20 to 30% more as far as a return on equity is concerned by unlocking that sleepy capital and reinvesting it into things that are producing 7 to 10, maybe 12% on average over any kind of couple year period of time. And that difference, that cash flow can be used to funnel and to fund a premium financing and policy, which then upon the death, that extra $4 million death policy, or let's say payout, is in addition because that's tax free. Talk about first of all, any questions on that, Jacob? What I just said, I know that's a lot. Did you follow that? It'd be good for you to repeat it so everyone can hear it. But number two, talk about how the premium or life insurance in general is tax free for the people that are receiving it.
Yeah, so good point. And no, and I agree with you there. To be fully honest, I follow. I'm tracking what you're saying, right? But some of the things, I mean, really, you've been doing it for years, so you understand it like the back of your hand. I mean, I'm just kind of getting into that world there. But going back to the insurance being tax free, I'm an insurance guy, I'm an educator, and I like to educate clients on what we can do to help them on the tax advantage side from trusts to different insurance policies. And we always go back to the tax code, which it's an IRC code, Internal Revenue Code 7702, which classifies insurance as being tax advantage status. And you guys could do some research on it. It's really just the basis of that loans coming out of the policy are tax advantaged, and the the insurance policy grows tax deferred, and the death benefit is also tax advantage to your beneficiaries as well. So, I mean, insurance is a good product, and you have to be within the guidelines. So there's a minimum premium to put the policy in force based on the death benefit, and there's a maximum premium. So if you go over the MEC premium, which is a modified endowment contract, that means, I mean, everything you take out on the income side would be taxable. The death benefit's still tax free. So there's some guidelines that you have to go between. And we're experts, and I would say we have a team of like 40 plus people that help structure these policies and manage them for the next 10, 15 years, just to make sure the policy stays in good order. We'll give you annual reviews, and we make sure it's the best situation and plan for your clients' needs.
Awesome, Jacob. Let me ask you about tax advantage. I'll make sure we got that right. So when you say tax advantage, do you mean that it's tax free to the heirs? Is that what you mean by that? Like, clarify what that means by tax advantage.
Correct. But they call it tax advantaged, right? They don't want to say the words tax free. They just use the words tax advantage, but it is tax free loans coming out of the policy if you want to take income, and it's tax free to the beneficiaries as well. Yeah.
Yeah. Okay. Perfect. Awesome. And
Yep.
we're
Yeah.
talking about,
Same, just different wording that they use.
yeah.
And I like to just kind of reiterate what the IRS
For
uses,
sure.
right?
Yeah, same reason we
Um,
don't say tax savings, we say tax deferral on the deferred sales trust. Although we do eliminate the estate tax, we can say that because we're moving it outside the taxable estate. But it's tax deferral on the DST 1.0. It's elimination of estate tax on the DST 2.0. But always the capital gains tax we're deferring. So yeah, I get what you're saying. That makes sense. We want to make sure you're saying it properly, right, within the guidelines of
yeah.
everything that we're going on here. Awesome, Jacob. Well, I think we've covered quite a bit today. Anything else? Any questions that you think that might be helpful for anyone looking at maybe the deferred sales trust for the first time, or some anything at all before we end this podcast?
Oh wow. Putting me on the spot there. I don't have any questions right now. I mean, it really comes across to me. I mean, for the client I work with, I mean, I would call myself a fiduciary, right? Where it comes into the play where I'm doing the client's best interest and I'm trying to put them, whether it's them working with you, whether it's them working with me on the premium financing or the life insurance, we're trying to just do what's best for them. So I need to learn more about kind of what you do on the back end, but I think it could be a good fit for some of the people we're working with, whether they're exiting businesses, real estate, um, anything in that sense, where they're facing some of those capital gains taxes. So it's definitely educational, and I appreciate you bringing me on here for me to share my story and kind of what we do to help clients because I think there's definitely synergies in both of our businesses and how we position these solutions to clients' problems.
Absolutely. So if you're watching this and you're interested at all in learning more about anything we've been talking about, especially if it's for premium financing, go to ufc.bz and look up Jacob Brigatti there. And or if you want to look up at the deferred sales trust, go to capitalgainstaxsolutions.com and mention that you watched this podcast episode. And let's dive into more solutions and ways. Let's bring Jacob in. Let's bring myself in to look at, again, what are you trying to solve for? What is your unique challenge and or desire for your wealth plan? And let's get together to try to solve that wealth plan, and to make build a great plan. By the way, if you want to learn more, and we actually, guess what, we wrote a book on it. It's called Building a Capital Gains Tax Exit Plan. Right. And so you got a chance to learn kind of the backstory of the deferred sales trust, how it came about, and how I learned about it, and how it helped my clients every day to achieve, what we call the 12 freedoms with the deferred sales trust. You have the 1031 exchange freedom, you have the diversification freedom, liquidity freedom, debt freedom, partnership freedom, entrepreneurial freedom, debt tax freedom, and a few others as well. You can go to Amazon and check that out. That's called Building a Capital Gains Tax Exit Plan. That being said, I appreciate everyone watching the show. Please rate, review, subscribe, and share